So I think we can start. We seem to be complete. Again, a warm welcome to our half-year's conference call. My name is Hardy. For those of you who don't know me, I'm CFO, COO of Basler, and I will run you through today's presentation and also the Q&A session. Before we start with the presentation, I would like to remind you on the disclaimer that the statements and also the content of today's presentations are based on information that are available at this time. Our forward-looking statements by nature are subject to significant known and unknown risk and uncertainties. Please keep this in mind. And let's come to today's presentation. Today's presentation has 5 different sections. We start with an executive summary. We then go into a deeper dive of the financials, have a quick glance to the share development, and by the end of the presentation, giving an outlook for the remainder of the year, but also for the midterm. And then we start in point 5 here, our Q&A session. Hope to have a lively one. Let's start with the executive summary. Looking first at the environment we were in the first half year, and it can be described with a very weak market environment. As we had it already in Q1, there was no bigger change. We see a weak market demand across all different regions. After a relatively robust 2023 in the European region, this region also started to cool off, and the Americas markets and also the Asian markets did not really wake up so far. There are slight improvements into especially the Asian regions, but it's on a very low level, so that all regions are very weak at the moment, or have been weak in first half year, but still weak at the moment. From the vertical perspective, from the applications, we see only certain signs of recovery at the moment in logistics, so especially on the fulfillment center optimization and also on the semiconductor side, front end, but also back end, but not on consumer electronics. Consumer electronics is still very weak, as many other verticals in the market at the moment. The inventory levels are still and has been high in the first half year on our client side, but they are reducing. So it's still a legacy effect from the chip crisis. So the effect or the higher value of the inventories are consistently going down. We believe we might have another, let's say, couple of months this effect, which are positive to us because it means step by step this muted demand will go out. But the majority of it is cleared up at the moment. In Germany, we see a situation where the industry, we have here the industry situation. Billings were down by 19% first half year of the German industry for vision components. So all the companies exporting worldwide, and bookings were down the first half year -7%. Let's have a look how we did in this environment. And first of all, we are making good progress after our restructuring in the second half of last year with regard to all key parameters we look at. However, our top line is still pretty much impacted by the weak market environment. So looking at our bookings and billings, our bookings were down by -2%. So industry was down -7%. So we are a little bit better here. On the billing side, we are very close to the market figure. Our billings were down 20% in the first half of 2024. What has to be mentioned is there is also a baseline effect because last year's first half was still relatively good, and then the second half we're going south significantly. So, and we are now seeing also this effect, the baseline effect, comparing first half to first half of the years. Looking more sequentially, we are making consistently progress on bookings and billings. So from Q2 or from Q1 to Q2, our bookings went up by 10%, our billings went up by 14%, and we are seeing this trend now for the fourth quarter in a row. We will see this later on the coming slides. Gross profit margin, also here we are improving compared to the first half last year. We improved approximately by 1.5 percentage points to 48.1%. Coming from, there is a typo here, coming from last year's 46.5. This should read half year 2023 versus half year 2024. So all in all, the restructuring is paying off. We are at what was a planned break-even point of approximately 200 million sales annually. Actually, we are more in the range of 195 at the moment. So on our pre-tax earnings, we're also a positive first time after 3 quarters, 1.3 million positive in the second quarter. For the first half year, we are still in the loss area of here 2.3 million euro. So looking at the team structure, we talked also about this in the last calls quite a bit. So you see the effect. Last year's end of first half year 2023 was approximately the top level of the number of full-time equivalents that we had on board. And this used to be 1,117. We are at the moment, or by end of first half year this year, at 882. So we are approximately 240 people less, or full-time equivalents, not people. You see that the structure has kept in place from the distribution of the different functions. We have quite a sizable R&D still on board, with approximately 220 people, full-time equivalents, heavily innovating on vision components or vision products. And we have invested approximately 15.5% on sales in the first half year on R&D. This also means we are continuously bringing out new products, innovations to the markets on all different kind of product fields. Starting here on the upper left side, we introduced in the second quarter recently new 3D stereo products. On the lower left, we also enlarged our portfolio of non-visible two-dimensional products on our ACE platform. So these are products where you can see beyond the human visual spectrum, for example, to look into a wafer or to look into a fruit in order to inspect defects that can't be seen by human eyes. On the frame grabber side, so our processing boards, we also came out with a new IMAFlex coax press high processing, high bandwidth frame grabber. And on the software side, we are continuously releasing new functions and features on our Pylon suite with regard to framework software, but also with regard to vision algorithms. Yeah, these are the organic new products. We are also proud to stress again, or to underline again, our recent investments in a small innovative company in the field of robotic vision. It's one of the pioneering companies, still a small company, very innovative small company, founded in 2015. They are based in Munich. Company name is Roboception. and they are approximately 14 employees, and their core products are 3D sensors, so hardware side, but especially 3D algorithms and software suite in order to make robots see to guide robots, and also to connect this visual sense, especially to robots, stationary robots, but also mobile robots. You can have on your own look on www.roboception.com to get a feeling about the company. We acquired a 25.1% stake. With that stake, we are the largest shareholder within this company, but there are some other shareholders also well-named company, and we are very happy to be part of this company and see how we can, with this company, also innovate the robotic industry. Yeah, these organic and also inorganic innovations and investments pay into our long-term strategy to develop the company from single component factory automation oriented company to a full line provider acting in different kind of vertical markets and become a full solution provider or a full range provider for computer vision over the long run and step by step. Yeah, let's come to the financials in more detail, starting from top line and going further then to bottom line. Starting with booking and billings, you can see here our quarterly development. And I mentioned this in the beginning of the call. We are making step-by-step progress, even though we want to make faster progress and we would like to be the markets and to be in a better shape. However, we can demonstrate a fourth quarter now in a row of growing bookings and also step-by-step growing billings. You see the last quarter's bookings here at 48.5 and 49.5 in billings. Second quarter of this year, and the book-to-bill ratios are, let's say, on the same level. For those of you who know us longer, this is relatively normal because our lead times are relatively short. So normal lead times are in the range of 2 weeks, 1 week sometimes. So bookings materialize in billings very fast and quick. So this also means that let's say, book-to-bill range of approximately 1 is a normal situation. Yeah, how does it look from the regional distribution standpoint? So from this 93 million in total sales for the first half year, we have realized 49% in Asia. So Asia is a bit faster growing than the other regions compared to the first half of last year. 35% came from EMEA, still a relatively in the long-term trend good value, and America stays weak with 16%. So that was the regional split. So we need to see what kind of markets or which markets will wake up, because it's obvious when semiconductor and consumer electronics will wake up, the Asian portion most likely will rise again. Yeah, looking at the gross profit in absolute terms and also in relative terms, here also we are making significant progress. So we had our, let's say, down or lowest values in the second half of last year with gross profit margins in the range of 38-39% points. Coming in the first half year last year from roughly 45 and coming long term from a level of 50-52%, we are now getting step by step back to where we have come from. So as you can see, we made very good progress from Q4 to Q1, and then also again from Q1 to Q2 to 44.6 and then 48.1% gross profit margin. together with the growth in sales, this also led to growing absolute numbers here. This is to be mentioned also in front of the background that we have still, let's say, negative influences at hand for our gross margins. The biggest one at the moment is the low economies of scale. So we are running at still a low revenue level. That means that our fixed costs in operations, so purchasing, production, are not very good scaled. But we still have also some spot buy legacy in our books that step by step will further go out. And on the currency pressures, we see, let's say, RMB to be weak. Yen recently changed, but in the first half year, the Japanese yen was pretty weak. And we also see continuous price pressure in China. But we have made significant progress here, and we are also working on further improvements. So those two angles, first sales growth, then gross profit margin growth, also has brought us step by step back into the profitability zone with 1.3 million pre-tax profit in the second quarter. We had still a loss of 3.6 in the first quarter. So here also we can see definitely the improvements. However, the weak sales around our break-even point is limiting us at the moment with regard to bringing the company back to a higher level of profitability. Yeah, the half-year comparison in an overview here from the P&L. Order entries 92.5, so -2%. Sales 93 million, -20%. Also here again, stressing the point with 116 million last year, we had a relatively good base. This will change in the second half of the year where the base is also getting lower. Gross profits in absolute terms 43.2, -17, so not going down as high as the sales because we made the mentioned gross profit margin improvements. EBITDA positive with 7.1, still significant behind the year before, and then earnings before tax -2.3, the overall half year coming from roughly break even first half of last year, and net income -3.4. Yeah, looking at the cash flow side of things, also here step-by-step improvements are visible, especially on the second quarter with our higher operational performance and earnings level. We were also able to have a higher operational cash flow. We still are, from the operational cash flow side, are behind our plans reducing the inventory levels because of the weak demand. So this would even be a higher contributor then. And on the investment side, it's worth to mention that in the second quarter, the 25.1% stake in Roboception is paid. So the normal, let's say, level of investments we run at the moment, intangibles and intangible assets are in the range of 2.5 million per quarter. So this means we were able to be free cash flow positive in Q2, but as you can see, Q1 was still negative, and the overall figure is also still negative. Yeah, the half year in total, we started the period with 32 million euro cash, then positive cash flow from operations 3.9 million, cash flow from investments -6 million, including the Roboception investment. So free cash flow -2.1, significantly better than first half of last year, however, not yet positive. Cash flow from financing minus 6.4. 2/3 of the 6.4 are also paying or reducing our loans, so payback loans. The rest is interest and finance lease, so that we ended the period with approximately 24 million cash account. Yeah, have a look. Let's have a quick look at the share performance. Yeah, nothing special in the first half year. So more or less a side move with also the uncertainties in the market, also with the situation the company is in at the moment. Yeah, development also relatively parallel to the TecDAX. I mean, recently, after yeah, now in July, there were also some developments. Now the share price is at around €9. So we definitely, what we are seeing, we have to further do, and this is our concentration point, doing our homework to bring back the company to a profitable growth track. On the shareholder structure side, no change in the recent months, so this is why I'm flipping through this slide quickly. Coming directly to the outlook and starting with our assumptions for the short term for the second half of this year, we expect a stepwise but slower recovery of market demand than what we have anticipated beginning of the year. We still see that our customers and also the macroeconomic data is, yeah, it's not really significantly improving. So this means for us, we see further gradually improvements of the market, but not really a strong rebound. And we see also this further improvements kicking in more in the fourth quarter than in the third quarter, because we also have summer season in the third quarter. So there's also a seasonality effect. With regard to the inventory levels, we expect to have, let's say, a couple of more months muted demand due to higher inventory levels at our clients, but it's definitely phasing out, and this effect will be over after, let's say, Q3 from now. Then this will be only an exceptional effect at some of our clients, but not a phenomena across the markets, across all clients. On the geopolitical side, yeah, definitely uncertainties will continue, will rise, unfortunately. Yeah, this is not in our hand. We can just do our best to make progress in this environment. We also expect a continuing of the very high competitive intensity, especially in China and Asia Pacific, due to the aggressiveness of the competition, but also due to the weak market demand. This goes hand in hand, and this has been already in the first half quite a competitive environment, and this will definitely continue. Yeah, having this said, under these assumptions, we confirm our guidance. However, we narrow it down to the lower half of it. So coming before previously 190 to 210 million in sales, our corridor, we are now narrowing it down from 190 to 200 million in sales. And on the earnings margin, pre-tax earnings margin, respectively, beforehand, we forecasted or guided 0 to 5% margin. We are now focusing it or narrowing it down to 0 to 3%. Yeah, we definitely expect further top-line improvements over the course of the year. I mentioned more the fourth quarter than the third quarter. We also work continuously on further improvements on the gross margin. We are also positive here, but on that side, I mean, definitely the improvement steps will become slower, as we have already gained quite a lot in the first half year or the first 2 quarters. We definitely will be continue our tight OPEX and CAPEX management as the weak markets remain. And this will be the managing mode for the coming months. For the midterm, we are more positive regarding the market environment. Sooner or later, we believe there will be a market recovery. At the moment, we expect this to kick in 2025. So this also leads us to the position that we confirm also our midterm guidance here, to achieve in 2027 300 million in sales, so to bring back the company to by and large 15% top line growth, and over the course of the next years also step by step bring the company back to 12% earnings margin level. This could be earlier than 2027. Let's see how the company develops, but this is our clear mission to reach the 300 million in 2027 at 12% earnings margin, and also a sound cash conversion rate of 70%. Here also the assumptions or the perspective has not changed. In order to achieve this, we still need to have access to the China market. I mean, it's still 23% of our sales exposure. So this is definitely a critical parameter we need to watch out closely. We are, let's say, positive, as I said, that the markets will recover sooner or later. There is a lot of macro or mega trends that are fueling vision technology, and also our strategy feels right. We are continuously further implementing our way to become a full line provider / solution provider for computer vision, to enlarge, let's say, the addressable market for us, and also to give us more room for differentiation. Yeah, this brings me to the end of the presentation, and I'm now looking forward to have a lively Q&A session.